This is a continuation on a series of videos regarding the Polaris theoretical valuation formula and how to use it. As a reminder, the formula here is basically, or is this right here. First video we talked about the derivation of this formula. Last video was on sales growth, and this video will be on profit margin. So you can see here the future profit margin, how it fits into the overall formula. We got to the Polaris website. If you scroll down to the bottom here, I'm looking at Walgreens. You can see that the forecasted future profit margin in 5 years is 3.5%. So if you as a user had some strong opinion about profit margin, this video is going to cover about things to think about, how to arrive at that opinion, and then once you have an opinion on profit margin, how to actually use the website to get that opinion reflected into the overall valuation. So the first place to go would be down here at the bottom on the Polaris website. Look to see if the company is considered stable or dynamic. If it's considered stable, then a profit margin like what we're seeing for Walgreens, future profit margin compared to current profit margin, is a reasonable thing for a stable company. But just to get a better idea of what other profit margins you may want to consider, first of all, you could just go look at the historical profit margin. Now, Walgreens was merged with another company out of England a couple of years ago, so we see quite a change in profit margin. Profit margins in general, once a company stabilizes, typically don't change all that much because of industry pressures and that kind of thing. But you can see here that Walmart has hovered around 3.5%, 4% for the last several years. The average over the time frame that's being shown here is 3.45%. So looking at that, it speaks to a 3.5% seems like a reasonable value to be using into the future. Another place to go look is at some websites. Could go out to the CNN site, but I'd rather go out and look at the Yahoo website. If you look under the statistics tab on Yahoo, you can scroll down. I'll tell you what the current profit margin based on the most recent, or I guess the most recent reported earnings, what the net income was relative to the overall sales. So there again, it's kind of reinforcing somewhere around 3.5%. Then another place I like to go look at is Dr. Damodaran from New York University has a website where he keeps a lot of spreadsheets on different values as it relates to the overall industry. If you scroll down here to the bottom, you will see that it has a thing on net margins by industry, and I'm going to go out here and look at the one for United States companies, and it'll be broken up by industries here in the United States. And if I scroll down to retail drug, let's see if he has a retail drug. Sometimes the categorization of companies are a little different depending on whose site you look at. I don't see a retail drug per se, so let's go up here to drug, citrus something, or here's this drug pharmaceutical. So this would probably be the most appropriate one to look at. And if you scroll all the way over to the right, and if I just take you up, you will see that you get, looks like I scrolled too far. I'm looking for profit margin. Yeah, it is net margin. Now it's interesting, it's showing a net margin of 14% for drug pharmaceutical.
That is likely a reference to pharmaceutical manufacturers, not retailers.
Yeah, but that's just the nature of this exercise. As you go look at different data sources, you decide yourself what a profit margin that you would think is more appropriate. Now this is the current net profit margin for the industry. Polaris doesn't show that, but it does account for that in its calculation of the future profit margin. If it would have been substantially higher, but at least the one that Polaris used, it would have used it, because the algorithm for future profit margin is assume the best case for the company, be as optimistic as possible about profit margin. So it either takes the company's current trending average profit margin over the last couple of years, it looks at the industry profit margin that it's considered to be part of, and then the sector that industry rolls up into. And it says out of those three average profit margins, use the most optimistic or best profit margin. So interesting that we're seeing Dr. Demoter and Site have a 14% profit margin, but if it would have been that high for the one that Polaris was using, we would have chosen it. But apparently a different way of looking at the industry. So now you're left with a little quandary: is should you assume a 14% profit margin or a 3.5? Well, that kind of an increase from 3.5 up to 14 would dramatically change the valuation. I'm inclined to stay more with the other places that we just looked at as a more reasonable profit margin is somewhere around 3.5. So let's say that we're just willing to bump it up to maybe 4% versus 3%. Well, even bumping it up from 4 to 3 is a 33% increase in profit margin. And just as a refresher, we did have another video to talk briefly about how to change these values. If we change the profit margin, the value would be 1.33 times the current value. So the current theoretical valuation is 86. If you were to bump it up by 33%, that would take you up to 114. So now I'm just going to move the slider around until I get around 114, and then I see what it does to my practical valuation or investment return of 15.5% and a practical valuation of 97.70. So I'm going to return it back to the default. Remember those numbers, particularly this one, 15.5% investment return versus a 12%.
Since this video was originally recorded, the Polaris website has been updated to include 2 additional sliders besides the sales growth slider, namely the profit margin, future profit margin slider, and even a future price earnings multiple slider. So in addition to what we just went through and how you would indirectly change the sales growth slider to reflect a change in opinion about the profit margin, you can directly change the profit margin now just by simply moving the profit margin slider. Also, since originally shooting this video, the Polaris website has been updated to capture additional information when plans are saved off. So for instance here, if we were to move the slider profit margin, future profit margin slider from 3.5 to the average profit margin in the S&P 500 of namely of 7.1%, and then add that to the plan, you would notice by going up here and looking at plan, scroll all the way right, that this information here captures the annual growth over the next 5 years. The 7.1% profit margin reflects over the current profit margin. And then that results in an earnings growth that's implied by that new profit margin of 7.1%. Results in an annual earnings growth of 15.8%. So we'd have to think through whether that kind of profit margin growth and resulting earnings growth is realistic compared to where the company currently is at. So that would be the exercise of going through, thinking through profit margin, entering just a profit margin change, and see what it would do to your overall investment return. Thanks.